Hi, welcome back. You're watching Halftime Report. The IT index, that has been a big outperformer, up 7% this week, up 11% this month, and a 28% rise this year. Can it continue? Full steam ahead. We ask Virender Jeet, Senior Vice President of Sales and Marketing at Newgen Software, and Apurva Prasad of HDFC Securities, who tracks these stocks very, very closely. Gentlemen, thanks very much for joining in. Mr. Jeet, my first question to you, how is Q2 shaping up, and do you think the outlook for overall FY21 is now a little bit more optimistic than it was, say, a few weeks ago?
Yeah, thank you for asking that. We are in a technology space, and as you understand, the technology has been a great tool right now to both restore businesses as well as get into the new normal. Having said that, businesses across the globe are using technology, more and more technology, to make sure that they're operational and they're able to really service their customers. For us, we had a good Q1 on account of a lot of traction coming from banking, financial services, especially government is driving a lot of loans and grants. And also the Q2 is looking strong for us. So technology companies in general are performing well. And businesses across the globe have come to a stage of what we call a new normal, rather than it is completely restored to the previous state. And people are moving ahead with their digital initiatives. So I think we don't see any. We still, we don't see the growth rates as they were in the previous years, but we surely are not looking at that kind of a gloom which was earlier predicted in end of March and beginning of April.
If you could put some numbers to it, Mr. Jeet, as you said, the first quarter was reasonably good for you. But in
we were able to grow. It was a low single digit growth, and we were able to expand our margins substantially because a lot of our costs are on the travel and the marketing expenses, which are more discretionary, which were optimized. Sure. On Q2, we expect again to maintain a kind of a growth momentum, which may be a single digit. And but on the margin level, we do expect that there's going to be still further improvement on that.
Okay.
And I do think in next couple of quarters, we see the momentum of digital initiatives really picking up, and I think the growth rates can come back.
Okay.
But if I ask me, I think in the short term and immediate term, decision-making cycles are still slow. Okay. People have not gone completely back to normal, but on mid-term and long-term, we are looking at it very positive.
Okay, all right. Let's get a couple of numbers then going. In FY20, you delivered a growth of around 6.5% or thereabouts in terms of revenues. Now, for this year, what kind of a number are you looking at? Are you looking at a single-digit growth?
We are hoping to maintain a growth momentum of achieving a high single-digit growth.
High single-digit growth. And in terms of margins, you are focused on, cutting various costs. And you're saying that margins could improve from here. So if you could give us a band in terms of margins we should be working with for the remainder of this year. Go ahead, sir.
So we are, as I told you, we are a product license company. So inherently, we operate at very high gross margins because that's the license business, and IPR businesses do operate at that. But a lot of our costs are really into our product R&D and sales and marketing. We do spend roughly around 30-35% of our cost in sales and marketing. And so this time, because of a lot of optimizations and in fact unable to do travel and do international engagements with customers, there is a natural optimization of cost. So we do expect that the margins will expand for us this year. And right now it's very difficult to predict because if the market opens, we'll be able to invest faster. But right now, from a previous year, we should be able to improve it substantially.
Hi Apurva, thanks for waiting by. Is this something that can be extrapolated for the sector, revenue growth, margin expansion? How are you assessing the growth of the IT companies?
Hi. So I've been fairly positive actually. We were actually quite lucky to get this cycle. We called out in early June that first quarter is going to be a possible bottom for the sector, and there's going to be growth from the second quarter. That seems to be pretty much the base case right now. But we've been fairly positive. I think a lot of demand drivers are in place on an incremental basis, and just the adoption of technology and the relevance of a lot of these services. I think that's becoming a lot more clear, I think, in adoption of technology. And if you just look at spend patterns across large enterprise clients on the large technology. So the largest BFSI companies, what they're spending on technology as a percentage of revenue, that continues to go up. In fact, if you look at some of the highly impacted verticals, and you see some of the commentary of travel majors or retail majors, I think the relevance to spend on technology, I think that continues to go up, which is going to be a multi-year type of a tailwind for the sector. And I think the other added big advantage factor is that historically growth for the sector has not just been a function of industry tailwinds. It's been more of market share gain. So I think that's probably going to continue. So yeah, fairly optimistic.
You like then in terms of stocks, Apurva, maybe from the large cap as well as mid cap, and do you believe it has more legs from here? Because as you said, you all got the call spot on in terms of turning positive, in fact believing that this rally was starting. But from here on, which stocks look good? Maybe from the mid cap and small cap indices.
Sure. So fairly positive on from the mid cap side, companies like Mphasis, L&T Infotech, although that's no more a mid cap, but that continues to be, we hold a positive view there. If I have to name maybe a small cap company from our coverage universe, Sonata Software. So I think these would be some of the names to really look out for. I would just like to highlight one more thing. I mean, if you look at the recent commentary of Accenture, in terms of their outlook, around these technologies, they're coming up with results sometime next week. We've talked about how workloads can move to, which is currently about 20% on cloud, and how that can probably go to even 80% in the next 5 years. So this was like a 10-year timeline, which was seen as for the industry. It probably can get accelerated to, even 5 years. So I'm saying even if you achieve half of that, that's a lot of spend which is going to come through, and which is very evident if you look at, some of the major SaaS players globally too. So I think the big tailwind for the sector is expected to continue. There will be some outliers and better performing company-specific factors which will be helping some of the names that I just mentioned.
All right. Let's get Mr. Jeet back into this conversation. Well, in your first quarter, Mr. Jeet, you said that the cloud revenue is up close to 30% on a year-on-year basis, but it was expected to increase even faster in the coming quarters. So what kind of a target do you have in terms of cloud revenue? And also give us a sense in terms of the receivables position. What was it? Has it improved now?
Yeah, so, as Apurva correctly said, I think there is a much stronger traction of moving customers are, increasing or reducing their adoption cycles, and what was going to happen in 5 years is happening now in 2 to 3 years. Cloud really provides them that kind of a risk aversion. So we do expect overall growth on the cloud side to continue or even to improve as we are able to sell more and more to the mature markets. US, Europe are typically the cloud where cloud play is more strong for us. And, on the receivable sides, we have really taken last 2 years and have really drastically improved. We have taken a target to bring it around 120 days. And I think as our subscription part of business, which is roughly around more than 50-55% right now, as that part of the revenue starts growing, these cycles will start coming down even further. The receivable cycles can get optimized up to 90 days over the next 1.5 years, 2 months.
Okay, all right. Well, before we let you go, Apurva, we wanted to understand from the large cap indices what looks good. I remember Infosys, just last year there was, a year, 18 months or so ago, there was some negative news. The stock had moved down to 550, 600 rupees odd. What's the view on Infosys from here, and from the large cap? What would be in terms of a pecking order?
Sure. So large cap, our pecking order is Infosys, HCL Tech. That's the one that we like. Although we have recently upgraded at TCS, but our preference would be for an Infosys followed by HCL Tech. So I think a lot of factors. I mean, just look at the fact that you've had probably one of the toughest ever quarters for the sector, and they've managed to win pretty much the largest ever deal. And this is not just Infosys, so I think this goes down across the board. So it's a lot more widespread, and it's not just some of the industry leaders who are picking up this trend. So it's not just the consolidation benefit which is accruing to the larger players. Having said that, Infosys and HCL Tech, that'll be the pecking order within the larger guys.
Right. A pleasure talking to both of you gentlemen. Thanks so much, Apurva, as well as Mr. Jeet, for stopping by and giving us an outlook in terms of the IT companies and the way ahead. So we'll keep a track on those IT companies. For the